All right. Good morning, everybody. Today is Wednesday morning. It's April 17th. I had to look down and check there for a second. We're a couple days past tax day here in the United States and southeastern Pennsylvania, and we are fully into spring at this point. I've been wearing shorts on the weekends and it feels fantastic. Steve, you know that. I'm here with my good buddy, Steve.parisi from IBC Global. Steve, good morning.
Morning, my friend. How you feeling?
Good, real good.
All right.
We're going to talk today. We're going to take a little departure from our normal ongoing conversation about whole life and cash accumulation and all the things that we all love and live and breathe every day. And today we're going to talk about annuities, and we're very excited.
It'll be a lot of fun, my friend. I'm ready.
Let's get right into it. So, Steve, in your experience, and now your ongoing experience and some of these topics that you're trying to educate your clients about. Start with just basics for, pretend I know nothing. I'm a neophyte and I come to you and I say, what even is an annuity? I hear this word. I really have no idea what it is. I heard it's a simple concept, but I don't get it.
Yeah, definitely. So I'll give you a simple overview of an annuity. What an annuity is a contract between you and a life insurance company. How it works is you give the insurance company a big pile of money. They say, thank you, Mike. We appreciate you giving us your money. But then in return, they give you your money back in most cases with a lot of interest too. So you can get income forever. What I heard once that I liked a lot is it's a lot like buying insurance for your money, where you're saying, here's a big pile of money, call it 100 grand. But then when you turn 60 or 65, when you want income in retirement, you're guaranteed to get $2,000 or $3,000 per month forever. So you're going to get a lot more than that $100,000 you deposit with the insurance company. Another way you could think of it is this way. Let's pretend you like real estate. Yeah. And there's this rental property that's available.
We don't have to pretend that I like real estate.
Yeah, no, I know, right? A lot of people do. But pretend for a moment there's a rental property, but you can only buy it with cash, right? So you can't take bank loans against it. So you purchase it with cash and you're guaranteed the following. It'll never have any property taxes. This is a fantasy world, right? But no property taxes are guaranteed. There's no future expenses. Maintenance will never occur. You don't have to take care of anything with the property.
Nobody's going to call me at any point.
Nothing. Again, fantasy world. And your tenant is guaranteed to pay on time every single month forever, no matter what happens. Yeah. Who wouldn't want that? If you're guaranteed those three things with a piece of property, would you want that property?
Right. Yes.
I would. Yes. Like, sign me up. Yeah. Sign me up right away. So there's a lot of similarities between that and an annuity when you look at it, because with annuities, you've got guarantees built in the contract. And where annuities are typically the strongest is when you're looking at the guaranteed income at some point in the future. And it's guaranteed. A lot of times, regardless of what happens to the account balance, the money you deposited, how I can explain it is you're just buying income for your money. So you say, here's a big pile of cash. I don't want to ever pay anything again, but in return, I'm guaranteed X amount of dollars in retirement. Does that make sense?
It does. So my first thought was, what's different when you said you give the insurance company money and when you get the money back, it's oftentimes with interest on top.
Yeah.
How is this different than high-performing money market account?
Yeah, good
question. You
question.
talked about the income portion of this. So how does that play in?
Yeah, so there's several different types of annuities. An income annuity would be the example we talked about, where I give the insurance company a pile of money and I'm really buying future income. I'm guaranteed an income stream, like the rental property example.
And I can select, like I'm assuming I can say I want income for 20 years at this point, or I want income from age 80 for life, or I want income. I can structure a different kind of income stream.
Correct. So you can pick up front, you can select lifetime income. A lot of times people are most comfortable with that, knowing that if I flip the income switch on when I'm 60, 65, whenever, here's the amount I'm going to get. and it's locked in forever. Like it's
Yeah.
not going to change. So again, you've got that guarantee there from the insurance company that they're going to pay you that much money forever. Like once you flip that switch on. Does that make
Right.
sense on the income side?
It does. Yeah.
Yeah. So how a growth annuity would work. So there's a lot of different types, but there's what's called a fixed annuity, which is the most straightforward type. That would be more comparable to a high performing money market you mentioned. I would even relate it more to a CD. So if I buy a CD at a bank, can I cash that out a month later?
I mean, you probably could, but there'd be a penalty that would,
Penalty
most
there.
likely preclude you from wanting to do that.
Correct. So the bank says, if you let us hold on to the money for a longer period of time, we're going to give you a little bit higher interest rate. So fixed annuities work almost the same way. Some people refer to them as insurance company CDs, right?
Okay.
So how it works is I give the insurance company a pile of money. I can see fixed annuity terms. Typically, they're anywhere from 2 years up to 10 years. And I'm guaranteed a fixed interest rate for the life of that term. So, for example, if I buy a 10-year annuity with a 5.5% interest rate, what that means is for the next 10 years, I'm guaranteed to get 5.5% per year, no matter what happens. It's going to
Right.
continue to compound too. So, very straightforward. I know exactly how much the money is going to grow by. One potential drawback is during that 10-year term, like a CD, if I had a 10-year CD, if I wanted to cash it out, I'd have penalties. With the insurance company, if I want to cash it out within the 10 years, I'm going to have penalties. The company will refer to this as a surrender charge, but I'll see that up front. I'll see exactly what it is. I do want to make sure that we're aware of those surrender fees and that I'm comfortable with them too. Does that make
Are
sense?
there survivor benefits with products like that, or is it just return of whatever the cash value is or the annuity value is at that point upon death?
Yeah, so typically it depends if you set it up where you've got an income rider or something like that. But typically, like if it's just a fixed annuity and I don't add anything on it, just plain, I want the rate of return, the account balance will grow. And then if I did die, I would designate a beneficiary when I start the contract that would be paid to my beneficiary if it's my spouse or whoever it might be.
Got it.
Yeah. With fixed annuities, I remember I got into the business in 2011. That it was not too long after '08, and interest rates were low, and everyone knows that they stayed low for a long time. I remember reviewing an annuity that someone had purchased. It was like 2006 or 2007, before '08. And I
Right.
think it was a fixed annuity, and the interest rate, I don't know, like somewhere between 6 or 8%. But pretend it was 8%. It was a fixed annuity. Pretend it's a 10-year fixed annuity that you bought in 2007. Interest rates go down. What's the benefit to getting that fixed 8% rate in 2007?
Well, you
You're
locked in a higher rate for,
10 years,
yeah,
right? So up until 2017. So that's one example of where fixed annuities can be very, very attractive to say, hey, if interest rates go down, I can lock in a higher rate for a long term right now. And there is zero risk with this product. Like it's
right.
not tied to the market. It's literally just a fixed interest rate. So someone who hears that and is attracted to that piece, that would be an ideal candidate for a fixed annuity. But there's drawbacks with that too. What if interest rates go up?
Right.
Go up. You're locked into
Sure.
whatever your rate was. What if you want access to the money? So I want to be aware of the pros and cons.
What about from a consumer perspective? What's typical for accessing this market and what do you have to look out for? Like, is this the type of product where, you know, as a consumer, you can just go online without the help of a financial professional and purchase, or you need to be working with someone who's licensed and qualified?
Yeah, good question. So you can definitely get a lot of information online. You can get sample annuities, whether it's through videos on YouTube or you can Google search information. Like you can get sample information and know enough to be dangerous when you ultimately purchase a product. To purchase a product or put money into an annuity, you still need to work with an agent there. A licensed agent will be your agent and they'll help you set it up. And then if you have questions, you can call the insurance company, but the insurance company usually encourages you to call your agent. So you will need an agent there. And I do think it would be beneficial to have one just so you can see different companies, products. You can ask them questions and say, hey, what would you do in my situation? What do most people do? Are there any questions that I'm not asking? Just really understand it more before you put money into it. Because with annuities, a lot of people have felt burned with them. They've had poor experiences, and it's always because of a lack of awareness.
Yeah.
Either they feel like they didn't do the research themselves, or the agent didn't make them aware, whatever it might have been. But then you've got people who have absolutely loved annuities. And the key difference is, because sometimes they have the exact same product, those two individuals, the difference is they were just aware of the drawbacks, like the surrender charges, if I want to access the money during the first 10 years, just have full awareness on what it is and how you want to use it, and does it fit? If it's a yes, okay, I can do it. If it's a no, that's all right.
So with regards to consumer access, sounds a lot similar to the life insurance space.
Yeah.
The other thing I wanted to ask you that also sounds similar to life insurance space with those growth annuities, just to get backtrack for a second, the growth during the growth period, I think is tax-free, correct?
Yeah, the definition that the IRS would say use and insurance companies would be tax deferred.
Tax deferred.
Yeah, it's a good point you bring up because that always comes up. So how you can fund an annuity, I can buy it with cash. I just write a check if I've got the money in my checking account. Or what a lot of people do is transfer or roll money over from an old 401k or IRA. Maybe they don't want it in the market anymore. So you can transfer it to an annuity. When you transfer it from a 401k or qualified account to an annuity, that typically is a non-taxable event, the rollover itself. Then as the annuity grows, it grows tax deferred. So just like the 401k, when that grows, I don't pay taxes on it. The same applies with the annuity. Now, when I begin to take income from that annuity, the same tax treatment applies to what I would have if I just left it in the 401k. So if you take money from a 401k, you got to pay income tax on it. If it's before age 59 and a half, you've got that potential 10% penalty tax.
Right.
With an annuity, same rules apply. The big thing to be aware of is if you're accessing the money within the first 10 years or when there's surrender charges, you've got the IRS penalties, and the insurance company might have some penalties too. So that's where we just want to make sure we understand what the purpose is for this money. Like if I'm not going to touch it for 10 years because I just want income or a big balance when I retire, then they're typically fantastic. If I think I might want it, I just want to know what those surrender fees are so I don't feel like I'm blindsided with a 40% hit on my money when it's all said and done.
What about the scenario where you make a lump sum purchase? Say it's a 5-year guaranteed rate period, and there's some growth in the contract, and at the end of the 5 years, you just cash it out and do something else with your money. In that year, you're paying tax on the gain.
Yeah. So if you bought a 5-year annuity that gave you 5% per year, and at the end of the 5-year term, you said, I don't want to renew, I just want my money back. If you bought it with cash, so non-qualified money, you would pay taxes on the gains in that case.
Right.
If you purchased that annuity with the 401k, if you transferred it over, at the end of that 5-year term, you might be through the surrender charges with the insurance company. However, if you're 50 years old at the end of that 5-year term, you can't cash it out. You would either have to A, renew it, or B, transfer it to a different annuity, or roll it over to something else, because you have to continue to defer that until 59 and a half if you don't want the taxes and penalties.
Understood.
Yeah.
So
Interesting
what are some, if you're talking about IRAs or you're talking about 401ks, I can see where this would be an attractive rollover vehicle. Talk a little bit about that. What are the pros? What are the cons with that type of business or that type of transaction from a consumer perspective?
Yeah, good question. So if I'm a consumer and I've got money in an old 401k, what I like is the growth potential during the years where the stock market does well. What I don't like is usually the fees and down years in the market. Talked to someone yesterday who is up there in age. He's getting closer to 60. He said when the market dipped a couple of years ago, it really impacted the balance. I don't want to deal with that anymore. Like it stresses him out more than what it did when he was younger. So what I can do if I want guarantees associated with my money and I don't want any risk of loss, this is where an annuity can fit. What he has as an option is to transfer his old 401k to an annuity. So what he's going to do is just roll it over. So when he transfers it over, there's no taxation. Now, when he begins to take income from the annuity, there will be taxation. And we don't know what he'll do yet. Depends on what he prefers and how soon he wants income. But he can either A, let it grow, tax deferred, or B, he can start taking income if he elects an immediate income annuity. And if he does that, then he will pay income tax on those payouts. That
As
makes
it's
sense?
coming.
Correct. Yeah.
Yeah.
Yeah. So
Not on the whole transfer at one time. It's
correct.
still always going to be.
Yeah.
Right.
Correct. So if I've got 100 grand in an old 401k, when I transfer it to a annuity, that's a tax-free rollover or transfer. When I pull money from now the $100,000 annuity, I'm going to pay taxes on whatever I pull out, just like I would if I left it in the 401k and started taking income from that. The amount I disperse, I'm going to pay income tax on.
How does that work from an advisor perspective? Meaning, because I'm going from a 401k, 401ks are made up typically of investments and
Yeah.
funds and things of that nature. An advisor who is not licensed or registered in that space, can they handle that rollover into this more annuity insurance vehicle?
Yeah, good question. So what you can do is you can transfer a 401k to a fixed annuity. A fixed annuity,
But it's going to be still a qualified
correct. Still, it's considered a qualified annuity, meaning
asset.
it's the same IRS classification, gross tax deferred, pay
Yeah.
income tax when you pull money out. With that, though, the insurance product, so the annuity is considered an insurance product. So if it's a fixed annuity or an indexed annuity, those are both classified as fixed insurance products. And what that means is you're not investing them in the market or doing anything like what you would with a 401k or IRA. Now, if you still want that market potential and you like the idea of an annuity, there are what are called variable annuities, which can be invested in mutual funds and such. However, if I don't want anything to do with the market anymore, I don't want any risk of loss, it just doesn't sit well with me, that's where you've got the fixed annuity products that are available. And again, you've got the fixed annuity, which is like the CD equivalent we talked about. Then there's also indexed annuities, which do have some nice upside potential. The simple concept is if the market goes up, you go up with it. If the market goes down, your principal is protected. So you won't lose money with those. So those are nice in concept. They offer a little bit more upside, but there are some things to be aware of. There's potential drawbacks like any product, but it's considered a fixed product because there's no money management or anything like that. I mean, you're with the insurance company.
Can you talk about the differences between variable annuities and indexed annuities?
A little bit. So with
It seems
variable,
like with both there'd be market exposure,
yeah.
right?
Yeah, so the main difference is just to super simplify things, a
Please.
variable annuity. Yeah, with a variable annuity, I have funds that can be invested directly in the stock market, if it's mutual funds or whatever it might be.
I'm
So-
your client. I come to you. I
Yep.
say, and again, 10,000-foot view. I say, I want this. Here's my money, but I want my money in the annuity to be tied to these 5 funds.
Gotcha. So if you have 5 specific funds, mutual funds that you like, with a variable annuity, you can accomplish that, right? If that's available there.
Right.
So with a variable annuity, if you put 100 grand in, if it's with mutual funds in the market, if the market goes down, your balance will go down with it. Now with variable annuities, you can attach income riders. You can do this with most annuities that you might say, I don't really care what the balance does because I'm guaranteed income at some point in time. So it is possible to do that. But to get back to your point, if it's variable, the word variable, it can go up and down. You
Right.
can see your account value go down. With an indexed annuity, so that's got some similarities. If you put the same 100 grand into that annuity, what happens if the market goes down, you don't lose any money. Your money's not actually invested in the market. If the market goes up, you go up with it, but you typically don't participate in 100% of the gains. So the best example to keep things simple is what the insurance company calls a cap rate. Think of it, I'm capped at whatever that rate is in terms of my total earnings for a year. So if I have a cap rate of 10%,
And my money is tied to some
yeah,
index, whether it's S&P
yep,
or Hang Seng or,
yeah,
one of the global indexes.
correct. So thanks for mentioning that. With an indexed annuity, I usually cannot pick those 5 funds or the different options that you would potentially have the ability to do with a variable annuity.
Right.
With an indexed annuity, I'm just tied to the S&P 500 or some other index, like you mentioned. But how it works is if I have that cap rate, call it 10%. If the S&P produced 30%, I would not get 30%. I'm capped at 10%. Now the cap rate could be higher. There's other crediting strategies that could give me more upside, but they might limit the earning potential as well. But my
Right.
point is you can participate in the gains, typically not 100%. So from the insurance company's perspective, they're going to say, you've got more upside with this product, but you're not going to participate in 100% of the gains. But what we're going to give you in exchange for that is if the market flatlines, your principal is protected. So you're not going to lose money.
Right. So
Yeah.
you're never gonna have a negative return with that type of product. You could have maybe you have a zero return.
Yeah. Correct. It could be zero. And the thing to be aware of too, if I just buy a flat indexed annuity and I don't attach any riders or anything like that, and the market goes down, if I've got a 0% floor, my balance is just going to remain level. Or if I have a guaranteed rate of 0.5%, it might go up a little bit.
Right.
But where people feel burned sometimes is if I get that indexed annuity and then I attach an income rider. Why I would do that is because that's going to guarantee me income down the road. However, if you attach an income rider, there is a fee for that that's assessed every year. Maybe it's 1.5 points, whatever it might
Right.
be.
Right.
The insurance company charges. So what
So you
that
could
does,
go down.
correct, if you attach that income rider. If you don't attach it, you won't go down. So it's just, building awareness on things like that. And if someone's buying it for income, maybe we'll look at an indexed annuity with an income rider or just a guaranteed income annuity, whichever one they like more and gives them more. But if they want just pure accumulation and they'll do something with it later, maybe we look at a fixed annuity or an indexed annuity without riders and such. Just strip out all the fees so I can get the maximum growth.
All right, so that's what I was going to ask. It sounds like these income riders are combining either a growth and an income based annuity or an index and an income based annuity. Then how does just a pure income annuity work?
Yeah, that's my favorite because the guarantees are just straightforward. So
But you still have accumulation value, correct?
you do, but there are fees associated with it. If you buy an income annuity, the
You're
item that I want to,
you're purchasing it for the income.
you're buying that
Not-
rental property that you
Yeah,
can't access the equity in, right? Think of it that way.
yeah, okay.
So if I get an income annuity, personally, I would want 100% certainty that I'm not going to want to access the principal, the amount of money I give to the insurance company. I'm not expecting it to grow at all. Maybe it will. There's some of them I might see grow a little bit. But if that's the intent, that's what excites me, I wouldn't get an income annuity because
Right,
an income annuity, the balance can go backwards, but it doesn't really matter because the insurance company says, you gave us the money. We're going to do what we're going to do with it. But in exchange, like what you've purchased from us, is the guarantee that we're going to give you income for the rest of your life when you decide you want to flip that switch on.
It's almost like, sounds like guaranteed UL. You know, when I have folks who are looking for a GUL, their sole focus is permanent death benefit.
Yeah.
You know, it's like a lifetime term policy. It's somebody who says, I want to pay the cheapest possible premium dollar to guarantee lifetime death benefit. And sometimes I'll be working on a case like that, and the client will start to look at the cash value in the illustration that really is irrelevant, because in a situation like that, if you touch the cash value, you're kind of blowing the guarantee. All
Yeah.
bets are off at that
Yeah.
point. And you see these cash values that grow and
No.
grow and grow and then start to decline. And it really is just not at all applicable to
No.
the case. The main goal is, what is my premium dollar giving me guaranteed?
Correct.
Whether it's death benefit, or in this situation, this guaranteed income stream that has a variety of different ways that
Yeah.
it can be structured up front, right?
Exactly. Yeah. I remember years ago, we were working with a woman. Her husband died. She got a large amount of money, life insurance proceeds, and she didn't know what to do with her money. Her banker was coming after her all the time because the money was in the checking account. He's like, hey, we can do all these things. And she's like, I don't want to do that, and stressed her out. She didn't know what to do. What did stress her out was just the idea of not running out of money. Like, she didn't want that to happen. She wouldn't, but this was a real thing to her. So what she did with some of that money, not all of it, but a portion of it, is put it into an income annuity, and it guarantees her a paycheck every month for the rest of her life. We looked at how much she would really, really need, and then rounded up a little bit because inflation happens. We always end up needing more money than what we think. Said, okay, here's how much money we can take from this big pile of cash to put it into an annuity. It guarantees you X amount of dollars for the rest of your month. And she's like, okay, that's perfect, because I don't want to have to think about it. I don't want risk. It's just not her appetite. And
Right.
that's not a fit for everyone. Some people like the thrill of growing their money, putting in the market and such. Then an annuity is definitely not for you. But it's
You're right.
just, how I look at it is understanding what it is, for what it is. How does it work? What are the drawbacks? Why would I not get this? Why would I get this? And can it help me? Can it improve what I'm doing now? And if it's a yes, all right, let's do it. If it's a maybe, I wouldn't do it until it's definitely a yes. If it's a no, no problem.
What's different from the income riders and the income annuity?
Yeah. So the income annuity, again, I'm just doing exactly what we mentioned there, where I'm buying future income and I've got the guarantees there.
It sounds like I can probably get more income out of that.
I think so. Now, every time I talk to wholesalers or specialists, they'll say, you can get an indexed annuity, and sometimes the income rider might give you a little bit more. I
It's
think,
not guaranteed.
I believe there are guarantees with some.
Sometimes yes, sometimes no.
Yeah. Also, I'm going to have a higher commission with an indexed annuity in most cases, like if it's an accumulation product with an indexed rider. So
Yeah.
whenever I get a response from someone that's saying, hey, here's the different options, you can attach an income rider and the income might be just as good down the road. I'm like, yeah. And it's like, look at your commission. It's like double the amount. I'm like, well, that's not why I want to do it. Which one
Yeah.
would I want with the strongest guarantees? So I
Right.
think that does have an influence just in the industry. To hit on your question, an indexed annuity with an income rider. So adding the income rider, that's if I said, okay, I do want to make sure I have income at some point in time, but
Or
I
the
want,
option for income too,
yeah,
right?
exactly. But I do want the potential of this money growing. Like, I don't want
Right.
to just say, hey, here's the balance and I'm guaranteed. I don't care about the balance anymore. Yeah, I want to potentially get some growth here. And I'm aware that some down years or some down years, my principal will flatline because of the concept of an
Yeah.
indexed annuity. But with the income rider fee, might come down a little bit.
And my understanding also is a little bit of an income rider in certain situations is something that down the road I could turn on,
Yeah.
or I might not. Whereas the income annuity is much more, I'm deciding on this. I want to lock in this future stream of income or this immediate stream of income,
Yeah.
and I want to be guaranteed.
Correct. Yeah. I
Yeah.
definitely want income when I retire. That's why I'm doing it. And there's income annuities that start within 30 days or 30 days after I purchase the product. Some I can purchase when I'm 40 or 45, let's call it. And I might want to start at 60. I might want to start at 61, 62, 70, whenever. And what you'll see when you purchase the product is the longer you wait to turn the income stream on, the higher the annual amount will be.
Right.
And I don't have to decide that upfront, which is nice.
Right. Nice.
Yeah. Counts for inflation.
Well,
Yeah.
listen, we covered a lot there, but guys, if you're listening and whether you're an advisor or a client or just somebody who's interested in doing research on your own, talk to Steve, talk to his team. Feel free to reach out to myself as well. Make sure that, the internet is great for research, but, you're not seeing what you're not seeing and you're not hearing what you're not hearing. And that might sound goofy, but make sure you're talking to a qualified professional who is answering your questions, showing you multiple options, and really making sense of this. If it's confusing, then I don't think you're getting the right advice because it really shouldn't be. I think Steve would agree. We just talked about a lot there, and it was just the basics, and it might sound complicated or like a lot of info, but I'm pretty sure a couple of conversations with Steve and his group, if this is a product that you're interested in, you can get your arms around it pretty quickly, as long as you're having the right conversations, right?
Yeah, it's not that hard. I mean, typically where we start is just showing one of each of the options. If someone doesn't know exactly what they want, here's a fixed annuity with just guaranteed growth. Here's an indexed. Here's the upside. Here's the flat years, and then here's a guaranteed income annuity. And then just go through the pros and cons and let them pick the one they like the most. And if it needs more, like helping them fit it into their overall plan, yeah, we'll do that too.
You guys can do that too.
Yeah,
Yeah.
yeah.
All right, guys. This is Steve Parisi, IBC Global. I'm Mike Courtney, Mass Mutual, Eastern Pennsylvania. Hope everybody has a great week, and we'll see you next time. Thanks, Steve.
Thanks, my friend. Talk to you later.